Hello guys, Lucas from Zignaly here. In this video I'll tell you about the differences between spot and future markets. Let's begin. Differences between spot and futures markets. I will use a simple example as an introduction. Let's say that you would like to take vacations and go from Turkey to India. You will need to exchange liras for rupees to freely spend money there. When you have your rupees in your wallet, you are ready to go. That was a spot transaction. What is spot price? The spot price is the current market price of an asset available to be bought or sold for immediate settlement. In other words, it is the price agreed between sellers and buyers which gives us a current market value of an asset. Cryptocurrency spot trading is the process of buying and selling digital assets such as Bitcoin or Ethereum for immediate delivery. That way, the cryptocurrencies are directly transferred between buyers and sellers' accounts. In a spot market, you have direct ownership of cryptocurrencies and you are entitled to related economical benefits, such as staking participation. Most frequently, spot prices are considered in the context of future contracts. One of the reasons for creating such a financial agreement is to lock in the desired spot price of an asset at some future date, because prices constantly change due to fluctuations in supply and demand. The spot price is a key variable in determining the price of a future contract. It can indicate expectations of a market about fluctuations in the future commodity prices. Spot exchanges act as a third party for buyers and sellers to bid and ask for a crypto asset. When a bid or offer is matched, the exchange will facilitate the trade. Spot exchanges operate 24 hours a day, 7 days a week, which means you can buy and sell crypto anytime and any day. What is a futures price? In the futures market, you are buying or selling contracts that represent the value of a specific cryptocurrency. When you purchase a future contract, you don't own that particular cryptocurrency. Instead, you own a contract with an agreement to buy or sell a specific cryptocurrency at a future date. As such, ownership of a future contract does not reward you with any economic benefits such as voting or staking. Crypto future contracts offer protection against volatility with hedging, for example, and adverse price movements on their underlying asset. Also, it is a proxy tool for traders to speculate on the future price of a specific cryptocurrency. With futures contracts, you can take advantage of and profit from any way price movements. Regardless of whether the price rise or fall, future contracts enable you to benefit from cryptocurrencies movements with ease. In other words, you can speculate on cryptocurrency's price rather than buying the crypto asset itself. If you expect the value of an asset to go up, you will buy a future contract to go long, and if you expect it to fall, you will sell it to go short. Your profit or loss will depend on the outcome of your prediction. Spot price versus future price. The main difference between spot and futures prices is that the spot ones are for immediate buying and selling, while futures delay payment and delivery to predetermined future date. So in spot, there is an instant transaction happening. In futures, there is a bid. Then the spot price is usually below the future prices. Traditionally, a spot market is traded with immediate delivery: commodities, currencies, stocks, and bonds. When holding cryptocurrencies in the spot market, you could potentially benefit from capital appreciation as the value of your cryptocurrency increase over time. In contrast, a futures market settles the delivery of its underlying assets and future contracts on a predetermined future date. Some of them could also exist as perpetual, so with no expiration date. Crypto futures trading versus crypto spot trading. Flexibility to long or short. When you purchase Bitcoin in the spot markets, you make a profit only if the price goes up. However, in a bear market, you can't make money. Futures contracts allow you to profit from short-term price movements regardless of direction. Even when the price of cryptocurrency falls, you can participate in the downward movement and trade along with the momentum. Additionally, futures contracts are also used to hedge against downside risk and protect a portfolio from extreme price volatility. Miners and long-term holders often use futures contracts to protect their portfolios from unexpected risks. Liquidity. The futures markets offer deep liquidity with trillions in monthly volume. For example, the Bitcoin futures market sees an average monthly turnover of $2 trillion, far greater than the Bitcoin spot market's trading volumes. That robust liquidity supports the process of price discovery and allows traders to transact in the market swiftly and efficiently. A liquid market is generally associated with less risk, because there is always someone willing to take the other side of a given position, so traders will incur less slippage. Leverage. Traders are drawn to the futures markets because of leverage. Leverage makes futures trading extremely capital efficient. For instance, to purchase one BTC in the spot market, you would need thousands of dollars, over $35,000 based on the current price. With a futures contract, you can open a 1 BTC, so over $35,000 futures position at a fraction of that cost. This is only possible with the use of leverage. The higher the leverage, the less is your personal capital percentage engaged on a position. Let's say you're opening $10,000 position with X10 leverage. It means that your capital contribution is $1,000 plus fees. In contrast, spot trading does not offer leverage. Suppose you have only 5,000 USDT available. In this case, you can only afford to purchase $5,000 worth of Bitcoin on the spot market. Binance allows up to 125 times leverage, which means if you start with $100, you can trade with $12,500. If you start with $1,000, you can trade with $125,000, which is crazy, and I'm not saying that you should do it. If you go 100x leverage in a trade, a 1% move against you will liquidate your position. Actually lower because of the trading fees. As one of my favorite trading services, Anti-Liquidation Tool, says, being liquidated means you made a subsidy payment to the insurance fund and defines you as an incompetent trader. Your stop loss should make liquidation very low probability. You need to have appropriate risk management and strategies to use 125 times leverage at all. It's hazardous, and that's how you can get wrecked, so lost all your capital in a few seconds. Futures, margin trading, is where you can make massive amounts of money, of course, but you can also lose a lot of money. And it's the only way when you can actually genuinely lose money. Because, for example, if you are spot trading and you buy random cryptocurrency and the price goes down, you didn't lose that money until you sell it. You can keep that loss. But if you wait or hold it long enough and the price goes back up, that money will still be there. Hopefully. With margin trading, you borrow money from an exchange for your leverage transactions. And if you get liquidated, that money is the exchange's. It's taken from you. You can't wait for the price to go back up. It's not like that. So you have to pay back to the exchange, and that's how you truly lose money. Spot trading is easy to understand and intuitive for most beginners. As such, is it the go-to venue for users who are new to crypto trading. However, future trading offers strategic advantages and allows you to maximize profits. Future trading can be lucrative if you have the appropriate knowledge and risk management techniques to avoid outsized losses. Thus, you should strategize and do due diligence before trading futures and understand both the advantages and disadvantages of that approach to the market transactions. I hope that this video was helpful for you and will make your choice between spot and future Zignaly Profit Sharing providers easier. However, if you have any questions, feel free to ask them under this video. You can also join our official Discord server and Telegram channel. We will be happy to answer you anytime. Thank you for watching. Until the next one.